Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified planning professional of the Cap and Capitalize. And on today's episode, we are going to get into, depending on who you talk to, an either very fun or not so fun discussion of credit card debt discussion. But before we do that, as always, the free advice for the week. Most people take their foot off the financial gas pedal in the summer. Don't be that person. Be the one that reflects on the halfway mark of the year, checks to make sure they are on track, and game plan an even more aggressive last 6 months to win the year. Not only is this fantastic just for planning advice, I would say it's successful. It's amazing advice just for life in general. I can tell you one of the blessings of living in Washington State is once the summer comes around, a lot of people in my area, they kind of just check out for an entire season. One, it makes sense because it's rainy up here. It can be dreary up until the spring, summertime. And then during the summer and even early fall, I mean, Western Washington is objectively like one of the most beautiful places on earth. However, the bummer with that is everyone takes their foot off the pedal. And then by the time October, November comes around, there's this mad dash for people to get what they should have been working on throughout the year done. But what's really cool is just by listening to this while everyone else is out partying their you-know-what's off and frankly just messing around, you can go, you can reflect, you can have almost a level of stoicism within your financial situation. And then what's cool is you can keep the compounding that you've had for the first 6 months of the year, and you can magnify that beyond your wildest dreams. So it's a little bit more motivation than advice, but I had to give it to you. Now, let's get into credit card debt and everything you need to know in terms of such. I want to first start with the psychology of credit card debt. And as a quick side note, a lot of people think that, oh yeah, okay, as a financial planner, like one goes and invests people's money and kind of just goes from there. That's actually a fraction of what an actual financial planner does. I would say the best financial planners out there are much more in tune. Yes, do they understand how to invest? Of course, but they outsource that to the best portfolio managers that they know and work with. I'm no different in that regard. They should understand tax code. They should understand tax strategy, all of that fun stuff. They should also understand that you don't just invest to invest. Like I tell people when they walk into my office, I will not invest your money at all unless there is a plan attached to that, because the plan dictates how the money needs to be invested, period. No questions asked. But even more importantly, behavioral finance in the psychology of money is where, frankly, the best in our industry, financial planning industry, make the most on behalf of their people that they are serving. So the psychology of credit card debt it's no different, and this is extremely important. And one of the things I was thinking is, how do people fall into these debt traps? Now, this is obviously focused on credit card debt, but it really applies to debt as a whole, because debt in and of itself, huge misconception with debt. Debt in and of itself is neither bad or good. It's merely a tool that you can use for your personal finances, or if you run a business, for your business. And, as all things in the world of compounding, debt can snowball into something extremely negative, which is probably why most of you are on this episode, and it rears its disastrous head by the time it's really too late. But it also can compound into something beautiful. So if you understand debt, and let's go to 2020 and 2021, if you had a home and you refinanced and you now have a 2.99% interest rate on your mortgage, and does it make sense to go and pay that off sooner? Or does it make sense to take any extra cash flow and earn something in the long run that could earn you, I don't know, around 7, 8, 9%? It doesn't even matter what you hit, but that's way more than 2.99%. So in the long run, in my book, we talk about capitalizing on the spread. You've earned that spread in the rate of return. And even though that sounds really simplistic, that's like one of the easiest yet most sophisticated tools that the most brilliant people in money in the world of money and finance in general use on a daily basis. So, didn't mean to go off too hard on that tangent here, but all things equal in the world of compounding, debt can be both good and bad. Now, I want you to think about interest rates a little bit more specifically, because it does come down to the interest rate. And the number that I always like to think of is the number 6%. That didn't just originally come from me. That actually came from Charlie Munger, who was Warren Buffett's business partner back in the day before he passed away at the tender age of almost 100. And his thing was, all I tried to do in the long run was earn, net of tax, 6%. And here's a guy that's arguably the greatest investor of all time. I actually could make an argument that he was a better investor than Warren Buffett. That's neither here nor there. But I tell you that because when you're taking on debts, one, you need to think of that number in your head that you think is an appropriate bogey. And then two, if you have any debts or interest rates that are below that, then by definition, you should take extra cash flow and reinvest to earn a higher return on that investment in the long run. Okay. Now, the exception to that is the credit card debt discussion, or really just debt in general. Sometimes it doesn't matter how much academia I throw at people. I know when I'm talking to them, they're just not going to understand or be able to officially capitalize, pun not intended, on the tasks and actions in which I'm providing to them. So what we do is we say, okay, even though I know this, we just need to free up as much cash flow as humanly possible, because if we don't do that, even though I know they're probably losing money in the long run, emotionally, it is going to give them a larger, more negative return on investment. So sometimes cash flow has to be the main focus. Now, what are some behavioral strategies to curb overspending in one's financial situation? Because people ask me this all the time. And unfortunately, there is no easy answer. Now, for some of you, right, it could be super obvious, but you're probably in denial with this. You know what I'm talking about. You shouldn't go on Amazon and just start binging. It's a Friday night. Maybe you had a couple glasses of wine above and beyond what is your threshold, and you just start scrolling and buying. Unfortunately, that's really common. Like, spending money is an addiction for people. And most of the time, it's as simple as taking your phone or your computer and you just put it off to the side. That's easy. Now, others of you may have like very legitimate woes with this. And that's where just prioritizing cash flow as soon as possible is mission critical. And depending on your situation, now, because we've ran into this, unfortunately, with not really with clients of mine, but like I've seen friends that come to me and go, Chris, I've just got this high interest credit card debt. I'm drowning in this. Like, what in the world can I do to get out of it? There are a ton of ways that you can get out of that. Many of these credit card companies allow you, or even banks would allow you to consolidate a lot of that debt. And then you could get maybe a 0% APR or interest rate equivalent. And then once you do that, you do everything in your power to pay that debt off as much as possible. Because a lot of people make the mistake and they go, oh, I just consolidated this high interest debt, this 27.99% interest rate credit card debt into a 0%. And I don't have to pay this thing off until 12 months. And then at that point, if I don't do it, the interest rate jumps back up. And therefore, I'm just going to ignore this and then try to make it up at the very end. No, because then you're going to do the same thing again. And that is not good. So once you do, or if you are able, to consolidate at that 0% interest rate and have that 12 months of runway, by God, do everything in your power to eliminate that, because then your cash flow is freed up and then you can go back to doing the really fun stuff, which is capitalizing on your future. Now, the true cost of debt. So not only are interest rates, which we talked about, important, but the minimum payment pitfalls is something I see all the time. So we've talked about the value of interest rates. I've talked about that actually ad nauseum in the last couple episodes recently. So if you need a refresher on that, go back and listen to the last couple episodes that we put out. But unfortunately, I'm not going to go too far on a tangent, but like the overspending issue, like that's just the way this country works. Country meaning the United States, for those of you that are outside of the United States listening in. And I say that because people take on debt, and then what they do is they look on their statements, and then there's that average line that you should pay, and then there's the minimum line, and then people just get hooked on, oh, I'll just go and pay the minimum. And they don't understand what danger lies ahead. It actually kind of goes off of what I mentioned in my emergency episode on what DoorDash and Klarna is doing. Like eventually the piper has to get paid, and people don't think about this. They just kick the can down the road until it's no longer their problem somehow. Well, it will be your problem. And I'll tell you, and I've seen this before too, where one thing after another, I've seen this with friends. You will blink and you will go from having basically zero debt to maybe a little bit. And then you open up your eyes and suddenly you have 20 grand in credit card debt at a 27% interest rate. And I'm just going to tell you, if you are not paying at least the required monthly amount for that, you are doing your future self a grave disservice. And a lot of people think of compounding, like compound interest on a rate of return on investment, as a good thing, which it can be. I mean, look at all the most successful investors in the world. They've compounded at a rate of return up and to the right. Great. A lot of people don't think about compound interest in the negative side of things with credit card debt. So remember what I said earlier in this episode, 6% net of tax. That should be a really good bogey for the majority of you of what you should earn in the long run. Do I think you can earn more than that? I do. Okay. But just use that as a number. And shoot, you know what? Use 8%. Hell, use 10% if you're feeling confident and cocky and arrogant about it. It doesn't matter what that bogey is. 27.99% is way more than all of those other returns I think you can earn confidently in the future. Look at Warren Buffett. Warren Buffett, through Berkshire Hathaway, who arguably is one of the best investors of all time, he's invested for like 80 years, I think. 80, 85? Yeah, 85 years, which is it's insane. Berkshire Hathaway, which just had it'll be its 60th year anniversary of him running the show there, has earned just a hair under 20% over that period of time. And he's considered one of the greatest investors of all time, which is very easy to look at. So you're telling me that you can go and somehow earn above and beyond the 27.99% return, which is 7% larger than what Warren Buffett has earned through Berkshire Hathaway over the 60-year career. There's no way. I'm sorry. There is no way you can do that. So you hammer that 27.99% until you are blue in the freaking face. So going to take a quick commercial break, and then when we come back, we're going to talk about some debt repayment strategies. And then we're going to close out with, if for whatever reason all else fails, where to go to seek professional help. So stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We cannot wait anymore. And by we, I mean me. I'm excited to talk about the debt repayment strategies for you to get out of credit card debt. So there's really two debt payment strategies that are popular. There's the snowball and then there's the avalanche method. So which one is best? So first I want to explain the difference. And a lot of you probably know what the snowball method is. The snowball method is referred to the lowest dollar amount outstanding. So if you have a list of debts, right, you go from lowest dollar amount to highest. And then the avalanche method is from interest rates from highest to lowest, okay? And so you pay down the highest interest rate first, and then once that's done, you take that free cash flow, go to the next highest, et cetera, et cetera. So all things being equal, the best option is going to be the avalanche method. Because remember, it's all about the interest rate you are earning on that debt, not paying off the balance of that debt. Because the balance in itself doesn't mean anything. Your return you earn means everything. Now, like I said, that was all things being equal because there are a few exceptions to that. So let's say that you may have a debt that isn't as high of interest, but it is simply sucking up all of the cash flow that you have, and it's nearly paid off. I can see, and I've actually made exceptions to this, that and again, not only have I seen exceptions, I've made the recommendation within my practice for certain clients to actually go and pay off that remaining balance, because not only from a behavioral finance perspective, like the person I'm talking to, like they simply can't comprehend the value of interest rates. Like it's just overwhelming for them, or it's just overwhelming for them altogether, just the world of money. Simply paying off that debt sooner, it's the only thing that will give them a remotely decent chance of having comfort in their lives. Okay. Now, one last thing before we keep moving on. You've got to remember, even though avalanche is the best route, once you get to a certain percentage of debts, it is, again, all things being equal, it's advantageous to keep those monthly payments and take the extra cash flow to reinvest into long-term investments where you can potentially earn a higher return than the interest rate on the debts you have outstanding and remaining. But if you are in this credit card debt, if it is extremely topical to you and you are drowning in credit card debt or just debts in general, you're probably going to want to just eliminate those, all things being equal, because for another reasons, a number of reasons I just mentioned. It could be overwhelming. You could just have really bad habits, and that's okay because you're eliminating those. Or it could be a combo of the two. Now, we've talked about this in the past with consolidating options like balance transfers on cards or personal loans. You really should look into consolidation credit cards or personal bank loans if you simply are drowning in the high interest credit card debts. And it all comes down to what I talked about in my first book, capitalizing on the spread. So if you can take a 27.99% interest rate, well, let's say you have 20 grand attached to that credit card debt, and then you get a bank loan of 20 grand to pay that off, but the bank loan is, let's say, 7.99%. You just earned a spread on 20%. on debt you otherwise won't have to pay. That's a huge deal. And obviously with credit cards, some of these you can consolidate into a 0% loan, which is fantastic. But the point is, look to consolidate if at all possible. Now, how do you avoid future debt once you've gotten into this point where you are out of the credit card debt dilemma? So you're going to want to create a sustainable budget. Now, unfortunately, as much as I want to say that creating a budget will help you avoid future debt, the fact of the matter is nobody knows what the future is going to bring you. And that's where I stress so hard for all of you listening, regardless if you're in debt or not, the value of a proper emergency fund. Because if you succumb to poor spending habits or temptation to use debt, increase, all things being equal, what you otherwise would regularly need in your emergency fund. So for example, most people need 3 to 6 months of emergency fund. Let's say you need 6 months. Maybe, you've got one income in the household. You're married, you got a couple kids, and everything is on you. But you do know that you have a spending issue, and you may need to tap into your emergency fund more so than the average bear. Well, if that's the case, instead of 6 months, you may need 7 to 8 months, because the odds of you tapping into an emergency, even though we know academically that's not probably the most truthful thing, it allows you to have some cushion to avoid getting into further debts like you were before you got out of it. And as far as using credit cards responsibly, because credit cards in and of themselves, and there's a lot of press on why credit card companies are bad. They go after people that simply don't understand the interest rate rules and all that fun stuff. Or they go after people that simply shouldn't have credit cards in the first place. I mean, like I said, credit cards actually can provide you a lot of positive opportunity with rewards, building credit. But again, if and only if you can be responsible with credit cards, using them in using credit cards that give you cash back, that's probably like the easiest win that you're going to have. Because really, if you think about it, you're getting paid for living your life. Now, is credit going to be important for buying like a home or a car? Yes, it's going to be important for all of these big purchases. But I want you to know that focusing on your credit score, don't make that your end all be all, because sometimes you'll go through life and your credit score will jump rather frantically for just a random reason. It won't even make sense. I can tell you, my wife and I don't know, I don't even know what our credit score is exactly. It's in the high 700s, I think. And I remember one month it dipped to 750 for really no reason. And I remember thinking to myself, what was the deal? Again, that credit rating's still fine, but I've seen people where that happens and they get so obsessed with that. And you're taking your eye off of what is most important in the world of finance, in your financial plan. So when to seek help, okay? So there is something out there called a credit counselor. Now, personally, I'm not a huge fan. And it's for the simple reason of principle. Think about it. If you know that people are coming to you and they're drowning in debt, why are you going to charge them to tell them that they're drowning in debt and give them action steps that they could otherwise get for free? That's just me. That's just me. I've seen people say, hey, we went to this credit counselor. He or she got us out of debt, blah, 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 blah. It's a thing of principle for me. But if that's what you need, credit counselors are out there. Now, for all of you that don't want to do the credit route, and a lot of you assume, hey, I'm drowning in this credit debt. I don't have a lot of money. So therefore, I can't afford to go talk to a financial advisor or a certified financial planner. That is the farthest thing from the truth. And if your plan and your finances are showing you signs of debt starting to spiral, and you need to take those practice steps. And if you work with a certified financial planning professional, you want to give him or her a call, like immediately. And if you do your personal finances on your own, that's totally fine. You just want to make sure that your cash flow is healthy, meaning you have enough cushion so that if something does come up, you aren't strapped for cash. And again, I mentioned earlier that emergency fund, I cannot stress it enough. And for whatever reason, emergency funds are something that both people want me to talk about ad nauseum, but then also no one wants to talk about it. It's just weird. I get it because emergency funds are kind of boring. Like once you have it, it just sits there and it doesn't do anything. But that's the purpose of having emergency cash off to the sidelines. So, what gets to be really fun too, and then we'll close this episode out, is as you start to climb out of your credit card debt and you get out of this credit or this debt cycle that you're in. Well, then what happens is you are able to have money in your emergency fund. And if you have it in a proper online savings account, your emergency fund can earn you a return on your investment. And then anything that you don't need on that money, you can go and take that interest and reinvest it into your portfolio. And then over time, what happens is your portfolio grows and grows and grows with the interest from your emergency fund on top of the money that you're investing within your portfolio. And then what gets really exciting is your portfolio starts to pay you a return, which then means in theory, you don't need as much emergency fund, which means you can retire that much sooner because your investments are paying for your lifestyle, not you. So that was a fun little tangent that I had to throw out there. And that's why your credit card debt discussion is a must to get out of. But I hope this was a perfect end and round out to today's episode on the credit card debt discussion. You guys know where to get a hold of me at this point. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Cap in Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. You should always seek counsel of the appropriate advisor prior to making any investment decision. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.